Welcome back, everybody, to another episode of Main Street Money. I'm Andrew Gay.
And I'm Zach Green.
As always, our goal here is simple. We take what's happening in the markets, the economy, and the world of financial planning and translate it into something useful for everyday investors. Now, we're recording this while the markets are still open Thursday afternoon, so some of the numbers may move around before the closing bell. But assuming markets finish roughly where they're at right now, this week wasn't really about earnings. It wasn't even about inflation. It wasn't about interest rates either. This week was about the Federal Reserve's new chairman, Kevin Warsh, and what his first meeting may tell us about the future direction of monetary policy. Let's jump right in. Segment 1, the market meets the new Fed chair. If markets finish near current levels, we're looking at another solid week for investors. The S&P 500 is hovering around 7,470. The NASDAQ's around 26,270, and the Dow Jones Industrial Average is approaching 51,600. Year to date, the S&P remains up roughly 9%, the NASDAQ around 13%, and the Dow around 7%. Those are strong numbers considering everything investors have had to digest this year. But what really grabbed Wall Street's attention this week was Kevin Warsh's first meeting as Federal Reserve Chairman.
And what stood out was not what the Fed did. Everybody expected rates to remain unchanged. What stood out was how Warsh seems to be approaching the job differently.
I agree. One of the biggest announcements from this week's meeting was the creation of 5 separate task forces to review major areas of the Federal Reserve policy. They're reviewing economic data collection, their artificial intelligence and productivity, communications and summary of economic projections, the inflation framework itself, and even the Fed's balance sheet. That's a pretty ambitious agenda for a first meeting.
Yeah, it almost feels like he's saying, before we decide where we're going, let's make sure we're using the right map.
That's exactly how I interpreted it. Instead of simply inheriting the previous playbook, Warsh appears interested in evaluating the playbook itself, and investors noticed. One thing we often remind clients is that markets don't move based on what happened yesterday. They move based on what investors think is going to happen tomorrow. And this week was all about future expectations. Segment 2, higher for longer. Now, let's talk about what may have moved markets the most this week. The Fed's updated projections. The new projections showed a much more divided Fed than we've become accustomed to seeing. 9 of the 18 Fed officials now project at least one rate hike by the end of 2026. The median Fed funds projection moved up from about 3.4% back in March to roughly 3.75. That is a meaningful shift.
Yeah, and Warsh's press conference wasn't exactly what investors would call a dovish one.
No, it wasn't. I would, in fact, say that it was hawkish. One of the shortest comments from the entire press conference may have been one of the most important. Warsh simply stated, the committee will deliver on price stability, which is the Federal Reserve's 2% inflation target. That's a pretty direct message. The Fed remains focused on inflation, and I think markets interpreted that as somewhat hawkish.
At the same time, though, some of today's inflation concerns are tied to energy prices and geopolitical events, especially the ongoing tensions in the Middle East. So it's kind of balancing those out right now.
Yeah, and that's where things get interesting, right? Many economists believe that some of today's inflation pressures are supply-driven rather than demand-driven. Higher oil prices, higher energy costs, geopolitical uncertainty, those aren't things the Federal Reserve can directly control. So if those pressures ease, inflation could improve faster than expected.
So the market's trying to answer one question. Are we dealing with a long-term inflation problem or a temporary energy shock?
And frankly, nobody knows with certainty. One thing that also stood out to me was that Warsh didn't submit his own rate projections. Neither did another Fed official for 2028. So to me, that signals something important. Even policymakers recognize there's a tremendous amount of uncertainty in financial markets right now. Segment 3, profits still matter most. Now, despite all the attention surrounding the Federal Reserve, let's not lose sight of what's actually driving stock prices, and that's corporate earnings. At the end of the day, earnings drive stock prices, and corporate America continues delivering. Current estimates show S&P 500 companies are tracking roughly 25 to 28% year-over-year earnings growth. That is a tremendous number.
Yeah, we've been talking about it for weeks now. The earnings story continues to be stronger than a lot of people expected.
Technology continues leading the way. Artificial intelligence continues driving investment in semiconductors, cloud manufacturing, and data centers. But this isn't just an AI story anymore. We're seeing strength across financials. We're seeing strength across industrials. We're seeing broad participation across the market. And that's generally what a healthy bull market looks like.
Mm-hmm. And I think this is a good example of investors sometimes getting caught up in the daily headlines. They forget that ultimately businesses have to make money.
They do. Politics matter, the Fed matters, geopolitics matter, but eventually it all comes back to profits. And right now, profits remain strong. Segment 4, our financial planning corner. This week's topic is sequence of returns risk. Every week, we try to connect what's happening in the markets to a real-world financial planning concept. This week, I want to talk about something called sequence of returns risk. It's one of the most important retirement risks that a lot of people overlook.
And it's especially relevant during periods of market volatility, like times we're in right now.
It absolutely is. So let's imagine two retirees. Both earn the exact same average annual return over a 20-year period. On paper, you would expect identical outcomes, right? Mm-hmm. Well, what if one retiree experiences a major downturn in the markets early in retirement while they're taking withdrawals, and the other experiences that same downturn, but much later in retirement? The outcomes can be dramatically different.
Yeah, because it's not just the return that matters here. It's when those returns occur, especially when you're taking income off the portfolio.
Hence the name sequence of returns risk. And that's why retirees often need a different strategy than someone who's still accumulating wealth and still working. When you're drawing income from a portfolio, a major downturn early in retirement can have an outsized impact. That's why we spend so much time talking about asset allocation, risk management, and income planning.
A lot of people focus exclusively on maximizing returns, but retirement planning is about much more than that.
It really is. It's about making sure your money lasts, because a successful retirement isn't determined by your best year. It's determined by how well your plan handles the difficult years. Segment 5, the big takeaway this week. So let's wrap things up. This week's market story wasn't really about whether rates moved. They didn't. It wasn't really about earnings. Those remained strong. This week's story was about expectations. The market got its first look at how Kevin Warsh may lead the Federal Reserve, and investors are beginning to recognize that rates could remain elevated longer than previously expected.
But despite that, the market continues showing resilience.
It does. Strong earnings, a healthy labor market, continued economic growth, those remain powerful forces supporting the market. If there's one takeaway this week, it's this: don't let short-term headlines distract you from long-term fundamentals. The headlines will change, the market narrative will change, Fed chairs will come and go, but successful investing still comes down to having a disciplined plan and sticking with it.
And that's especially true during periods of uncertainty.
Couldn't have said it better myself. Thank you all for joining us for another episode of Main Street Money. We're Texas Hill Country Advisors. You can find us online at texashillcountryadvisors.com, on Facebook, LinkedIn, Spotify, and YouTube. Thank you guys very much. Have a fantastic long weekend. We will see you back here next week. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior